Ever looked at a stack of financial reports, all those dense numbers and footnotes, and just wished someone could cut through the jargon, just tell you what really matters? What's the hidden story, maybe the aha moment? Well, if you're curious about the beating heart of India's banking sector, you're definitely in for a treat today. We're taking a deep dive into HDFC Bank's Q1 FY26 financial results. These are fresh off their board meeting on July 19th, 2025.
That's right. We've gone through the detailed press releases, the presentation slides, all the various financial statements. And our mission really is to distill all of that down for you, get to the most important nuggets of knowledge, the key insights, give you a crystal clear picture without, the usual information overload.
Exactly. We'll unpack the big numbers, look at the key drivers behind them, and then, importantly, discuss the strategic stuff, the things that go beyond just profits and losses. That's where it gets really fascinating, I think. So let's kick off with the overall financial performance. What were the absolute standout figures for HDFC Bank in this first quarter of FY26?
Okay, well, the top line numbers, they definitely grab your attention straight away. Yeah. Net revenue for Q1 FY26, it soared to $531.7 billion.
Wow, okay.
Yeah, that's a truly significant jump. It's up 31.2% year on year compared to the $405.1 billion they posted in Q1 FY25. Now, here's a really crucial detail you need to keep in mind. This substantial increase, it includes a very notable sort of one-time transaction gain. It was $91.3 billion.
$91.3 billion, that's huge. Where did that come from?
It came from a partial divestment in the recent IPO of their subsidiary, HDB Financial Services Ltd.
Ah, right. The HDB Financial Services IPO, that certainly made a splash. So, okay, that boosted the revenue number significantly. But beyond that one-time windfall, how did the bank's underlying operations actually perform? What's the picture for their core earnings when we, look past that strategic sale?
That's the absolutely critical question, yeah. So profit after tax, or PAT, for the quarter was $181.6 billion. Now, that shows a solid 12.2% growth over Q1 of FY25. So still growing nicely.
Okay, 12.2% growth on the profit.
Exactly. And operating expenses for the quarter were $174.3 billion. That's a pretty manageable 4.9% increase year on year. And if you look at their core efficiency, the cost-to-income ratio, if you exclude those transaction gains we just talked about, it stood at a very healthy 39.6%.
Under 40%.
Right. So what this basically means for you is that even when you adjust for that significant one-off gain, the underlying growth in net revenue was still positive. It demonstrates a pretty robust core performance.
Got it. And earnings per share? Right.
Standalone earnings per share for the quarter came in at 23.71, and the return on assets, or ROA, stood at 1.93%.
Okay, 1.93%. Let's unpack the bread and butter now, net interest income, NII. How did the core business of lending and taking deposits perform?
Right, the core engine. So NII for Q1 FY26 was $314.4 billion. That's a 5.4% growth compared to Q1 FY25.
5.4%. Okay, so slower growth than the overall revenue, which makes sense given the IPO gain.
Exactly. And their core net interest margin, or that key profitability metric, is 3.35% on total assets.
3.35. Now, wasn't that slightly down from the previous quarter?
Yes, that's right. It is down just a bit from the 3.46% they reported in Q4 FY25. What this essentially signals, for the bank's profitability is that the cost of their funds is rising slightly faster than the returns they're earning on loans. It puts a little bit of a squeeze on those core margins.
Okay. Makes sense in the current environment. What were the specifics? Yield on assets, cost of funds?
Yeah, the yield on assets was 8.1% and the cost of funds was 4.8%.
Right. So margins are a bit tighter. That's an interesting dynamic to watch. How did the bank's loan book and, crucially, its deposit base perform this quarter? Because deposits are really the fuel, aren't they?
Absolutely. Deposits are king.
Yeah.
And they did very well here. The total balance sheet size as of June 30th, 2025, it expanded to $39,541 billion. That's up a strong 10.8% from Q1 FY25.
Okay.
On the deposit front, average deposits were remarkably strong. They hit $26,576 billion. That's a 16.4% growth year on year and a solid 5.1% quarter on quarter.
Really good momentum. 16.4% year on year on average deposits. That's impressive mobilization.
It is. And their end-of-period deposits were $27,641 billion, also up significantly, 16.2% year on year. Now, looking at KESA deposits, the current account saving account funds, which are generally cheaper for the bank, average KESA grew by 6.1% year on year to $8,604 billion. KESA deposits now make up about 33.9% of total end-of-period deposits.
Okay, about a third. And time deposits, fixed deposits.
They saw really robust growth, up 20.6% year-on-year, reaching 18,271 billion. So very strong mobilization efforts there too.
So strong on the deposit side. What about the lending side, the advances?
Yeah, solid growth there too, though maybe not quite as explosive as deposits. Average advances under management were 27,423 billion. That's up 8.3% year-on-year. Gross advances at the end of the period were 26,532 billion, a 6.7% increase year-on-year.
Okay, and the mix within that, retail, corporate.
It's a pretty healthy picture when you dive in. Retail loans grew by 8.1%. Small and mid-market enterprises loans, SME lending, grew by a strong 17.1%. That's quite notable.
17%? Wow.
Yeah. And corporate and other wholesale loans grew by a more modest 1.7%.
And drilling down into retail specifically, anything stand out quarter on quarter?
Well, within retail, looking quarter on quarter, we saw growth in mortgages. That was up 0.9%. Personal loans grew 1.2%. Auto loans up 1.8%. And gold loans showed particularly strong growth, actually, up 6.8% quarter on quarter.
Gold loans, interesting.
Yeah. There was a slight dip quarter on quarter in the categories they call other retail and payment business advances, but overall, pretty solid expansion across the board.
It sounds like healthy growth across most key segments then. But, growth isn't everything in banking. You also want to make sure the money you lend out is actually coming back. Imagine running a business where bad debts are your biggest worry. So how healthy are HDFC Bank's loans? Let's talk asset quality.
Right, asset quality is always crucial. Let's dive into that. Their gross non-performing assets, or GNPA, stood at 1.40% of gross advances as of June 30, 2025.
1.4%. How does that compare?
It's a slight uptick, actually. It was 1.33% in the prior quarter, March 31st, and also 1.33% back in Q1 of FY25. So a small increase.
Yeah.
However, it's worth noting, if you exclude NPAs, specifically in the agricultural segment, which can often be more volatile or cyclical,
Right.
then the GNPA was a healthier 1.14%.
Okay, 1.14x agri and net NPAs after provisions.
Net non-performing assets and NPA were at 0.47% of net advances.
0.47%. So quite low on the net side.
That's right. It indicates pretty good recovery efforts after they've set aside provisions.
Now, speaking of provisions, this is where things get really fascinating this quarter, isn't it? You mentioned earlier the bank noted a benign credit environment, yet provisions have significantly increased. That seems a bit counterintuitive. Can you elaborate on that? What does it tell us?
You've absolutely hit on a crucial point there. It is quite interesting.
Yeah.
Provisions and contingencies for this quarter, ending June 30, 2025, were significantly higher. They came in at $144.4 billion.
Wow. $144 billion compared to what last year?
Compared to just $26.0 billion in Q1 of FY24, so a massive jump.
Huge. What drove that?
Well, this increase includes a substantial euro 90.0 billion in what they call floating provisions. And there was also an additional euro 17.0 billion in contingent provisions.
Floating provisions, 90 billion. What exactly are those for? Are they seeing specific problems brewing?
That's the interesting part. The bank explicitly stated these floating provisions are not specific to any particular problem loan portfolio or any specific anticipated risks. They describe them as a, quote, counter-cyclical buffer to enhance balance sheet resilience.
A counter-cyclical buffer, so building reserves even when things look okay.
Exactly. It's a very proactive approach. Building these significant floating provisions, even while describing the credit environment as benign, clearly signals management's foresight. It suggests they're implicitly acknowledging potential future economic volatility, maybe related to those global tensions we hear about, or domestic inflation, perhaps.
So they're basically building a financial rainy day fund, just in case, even if the forecast is sunny right now.
Precisely. It isn't tied to any specific bad weather forecast, but just preparing for the possibility. It's a conservative, long-term strategic move, really about weathering potential future storms.
That's quite telling. What about their coverage ratio?
Yeah, the specific provision coverage ratio, or PCR, was 67% as of June 30, 2025. That further underscores their cautious stance.
Okay, very interesting strategy on the provisions front. Let's move beyond the core interest income from lending. How else did HDFC Bank generate revenue this quarter? Because, a diversified income stream usually means a more resilient bank.
Absolutely. Diversification is key. And their other income, or non-interest revenue, was, well, remarkable this quarter. It came in at $217.3 billion. That's a staggering 103.7% growth year on year.
Over 100% growth. Okay, what's in that number?
Right, let's break it down. Fees and commissions were $75.9 billion. That's up nicely from $70.5 billion year on year. And it's worth noting that retail fees contribute a significant 94% of that total fee income. Really shows their focus on individual customers.
94% from retail fees. Okay. What else?
Foreign exchange and derivatives revenue was $16.3 billion. That's up from $14.0 billion year on year. Then there was a net trading and mark-to-market gain of $101.1 billion.
Uh-huh. There it is again. That must include the HDB gain.
Exactly. That euro 101.1 billion figure notably includes that very significant euro 91.3 billion transaction gain from the HDB Financial Services IPO divestment we discussed earlier.
Right. So that really supercharged the other income line.
It really did. And finally, miscellaneous income, which includes things like recoveries and dividends, contributed euro 24.0 billion, also up from euro 20.1 billion year on year. So, yes, while their core fee income is strong and growing, that one-time transaction gain from the HDBFS IPO truly boosted the non-interest income this quarter, made it a real standout performer.
Okay, understood. Now, the merger with HDFC Ltd was obviously a monumental event in the Indian financial landscape. It feels like a while ago now. But how is the integration progressing? And how is the bank's overall financial health looking in terms of capital strength, especially post-merger?
Yeah, the merger continues to subtly impact the numbers, driving that overall narrative towards a more diversified and integrated income stream. Though to be fair, specific financial synergies from the merger aren't explicitly broken down in these Q1 numbers beyond those initial impacts we saw right after it happened. However, in terms of capital strength, well, HDFC Bank's capital position is absolutely rock solid.
Rock solid. How solid?
Yeah. Their total capital adequacy ratio, or CR, as per the Basel III guidelines, clocked in at a powerful 19.9% as of June 30, 2025.
19.9%. And the regulatory requirement is?
It's significantly above the regulatory requirement of 11.9%. Huge buffer there.
Wow, okay.
And their Tier 1 CR stood at 17.8%, and the Common Equity Tier 1, or CET1 capital ratio was 17.4%. These figures, they really highlight a truly robust capital position, gives them substantial headroom for future growth, and, importantly, resilience against any unexpected shocks.
That's very strong indeed. Now, the HDFC brand is so much more than just the bank itself, isn't it? It's the sprawling financial ecosystem. How did their key subsidiaries perform this quarter, and what else was notable from the board's strategic decisions?
Indeed, the whole group ecosystem is quite a powerhouse. Let's quickly run through the key players. First, HDB Financial Services Ltd, HDBFSL, the one involved in the IPO. The bank holds a 74.19% stake post-IPO. HDBFSL reported net revenue of $27.3 billion and a profit after tax of $5.7 billion for the quarter. Its total loan book was $1,093 billion, and gross Stage 3 loans, those are the non-performing ones, were at 2.56%.
Okay, 2.56% Stage 3 at HDB. Got it. Next.
HDFC Life Insurance Company Ltd. The bank holds a 50.3% stake here. It saw its profit after tax grow by a healthy 14.4% year-on-year to $5.5 billion, and its assets under management, AUM, reached an impressive euro 3.6 trillion.
3.6 trillion AUM for the life insurance arm.
Strong. Then there's HDFC Ergo General Insurance Company Ltd, also a 50.3% stake. This one showed particularly strong growth, actually. Profit after tax jumped by a robust 56.4% year-on-year to $2.1 billion.
56% profit growth at Ergo.
Yeah, very strong. Next, HDFC Asset Management Company Ltd, HDFC AMC. The bank holds 52.4% here. It recorded quarterly average assets under management, QAAUM, of $8.3 trillion. That's up 23.8% year-on-year. Profit after tax was $7.5 billion.
8.3 trillion in assets managed by the AMC. Huge numbers.
They really are. And finally, HDFC Securities Ltd, HSL. The bank holds a commanding 94.4% stake here. HSL had total revenue of $7.3 billion and a profit after tax of $2.3 billion for the quarter.
Okay, so the subsidiaries seem to be performing well overall. Now, beyond these financials, the board made some pretty significant announcements, didn't they? What were they, and what do they signal to investors, do you think?
Yes, two major announcements came out of the board meeting. First, they declared a special interim dividend of 5 per equity share. That's based on the pre-bonus share count.
Okay, a special dividend, nice for shareholders.
And perhaps even more significantly, they also approved a 1.1 bonus share issuance.
1-for-1 bonus, so double the shares outstanding, effectively.
Exactly. For every 1 share you hold, you'd get another bonus equity share. Of course, this is still subject to regulatory and shareholder approvals, the usual process.
Right. But a 1-for-1 bonus issue alongside a special dividend, what does that signal? That sounds like strong confidence from management.
It's a very powerful signal, yes. Immense confidence. It suggests they believe the bank's intrinsic value is robust and growing strongly. They're rewarding shareholders directly with the dividend, and the bonus issue makes the shares potentially more accessible, psychologically cheaper per share. It definitely indicates a strong, long-term vision and a deep commitment to shareholder value. Signals they expect continued strong performance and growth ahead.
Makes sense. Big confidence signals there. How about their physical presence, their reach across India? In this increasingly digital world, does that physical network still hold a lot of weight?
Oh, absolutely it does. Especially in a diverse and vast market like India, you can't discount the physical presence. As of June 30, 2025, the bank's distribution network reached 9,499 branches, almost 9,500,
9,500 branches.
and 21,251 ATMs. These are spread across 4,153 cities and towns in India. And what's particularly notable, I think, is that 51% of these branches are strategically located in semi-urban and rural areas.
Over half outside the main metros.
Exactly. This isn't just about sheer numbers. It demonstrates a very deliberate commitment to wider financial inclusion, building trust in underserved markets and tapping into growth opportunities beyond just the big Tier 1 cities.
Yeah, that's a significant strategic footprint. And employees.
Their employee count also increased, reflecting this ongoing expansion. It reached 218,822 people.
Okay, so bringing it all together now, what insights can we glean about management's view on the future, and what external factors does the bank highlight as potentially impacting its performance? Are they seeing clear skies ahead or maybe some potential clouds on the horizon?
Well, the bank's management commentary notes, as we mentioned, a benign credit environment currently. And they highlight continued steady credit performance across all their segments, which is definitely positive. They also made a point to highlight their commitment to ESG, environmental, social, and governance factors.
ESG is increasingly important. What are their targets?
They're targeting carbon neutrality by FY32. And they noted that sustainable finance currently makes up 18.69% of their total loan book. They also mentioned a gender diversity ratio of 26% in their workforce. So clearly focusing on these broader aspects beyond just the financials.
Okay, good to see. Now, what about risks? What external factors are they flagging?
Right. Regarding the external landscape, they are, as you'd expect, quite comprehensive and transparent about potential risks. They acknowledge various factors that could impact future results. These include geopolitical tensions, specifically mentioning India-Pakistan and India-China relations. They also list broader global conflicts, the Russia-Ukraine war, the Israel-Hamas conflict, the recent escalation between Israel and Iran, and the ongoing Red Sea attacks impacting trade.
A lot of global uncertainty there.
Indeed. They also monitor domestic factors, like potential military armament or social unrest, and of course the usual suspects, monetary and interest rate policies from the RBI, potential natural calamities, future pandemics, inflation or deflation risks, and general volatility in financial markets.
So a standard but comprehensive list of potential headwinds.
Exactly. They impartially report these as potential risks they are actively monitoring. It reflects a comprehensive and appropriately cautious view of the operating environment. An awareness that external forces can always shift the landscape, regardless of how strong the internal performance is.
Makes sense. Always good to be prepared. So let's try and wrap this up. What does this all mean for you, our curious listener? We've seen HDFC Bank demonstrate, well, a quarter of pretty solid underlying performance, wouldn't you say? Definitely boosted significantly by that strategic HDB divestment. And they're taking that remarkably proactive approach to strengthening the balance sheet with those floating provisions, even in what they call a benign environment.
Absolutely. If we connect this to the bigger picture, the bank's continued strategic focus on mobilizing deposits, which they did very well this quarter, coupled with that rock-solid capital position we discussed and their ever-expanding physical and digital network, it clearly positions them for ongoing leadership, ongoing influence in the Indian financial sector. They're not just growing, they seem to be actively fortifying the bank for the long haul.
Yeah, fortifying seems like the right word, especially with those provisions, which I guess raises an important final question for you to ponder. With these strategic moves, like the bonus issuance, signaling confidence, that huge investment in building a proactive financial buffer, and their deep dive into expanding reach across India, how might HDFC Bank not just adapt, but actually innovate to shape the future of banking in India? Could they influence the broader global financial landscape even more in the coming years? What cutting-edge services or fundamental shifts might emerge from this clearly formidable financial giant? Something to think about. Thank you for joining us on this deep dive today. We really hope you're feeling well-informed now and maybe ready to explore some of these fascinating insights a bit further.